And our next guest thinks it's just the start for the group, saying investors should go overweight in 2024. Gerard Cassidy is head of U.S. Bank Equity Strategy at RBC Capital Markets. Gerard, welcome. Good to have you with us. Who'd have thunk that the financials would be doing as well as they have been doing, given the fact that it was just 9 months ago that we had major failures of a couple of mid-level banks?
Very true, Tyler. And when you take a look at what happened back in the spring, it was very, very idiosyncratic. And on top of that, there was no contagion. And the reason there was no contagion was the Fed moved very aggressively, which was good, of course, but also those banks' business models were unique to them. But to your point, now that we see the Fed might be at its terminal rate for Fed funds, and we may actually have a soft landing in 2024, these are two huge positives for the banks, especially when it comes to credit, because credit trumps interest rates. And if we have a good year for credit quality, which we think we will in a soft landing, that's a real positive for the bank stocks.
One of the things in your most recent report from December 14th that you point out is that once interest rates hit that terminal rate and begin to roll over, historically speaking, that is a period when banks outperform the broad market and by a substantial measure. Take us through some of that history.
Sure, Tyler. In fact, I'm glad you brought that up because the classic example was the 94-95 time period. Some people may remember Federal Reserve Chairman Greenspan raised rates from 3 to 6%, ending in February of 95. The stocks bottomed at the end of 94, and that peak in Fed funds rates was the catalyst for the stocks to go up 55% in 1995. Another good example, Tyler, was 2004-2006 tightening cycle. When you look at that cycle, same thing. The stocks outperformed in 06. They were up over 20%. The challenge, however, as we all remember, was the financial crisis hit in 08, and the stocks were totally decimated because of credit problems. So those are two good examples people can look to. And the important thing is credit. Credit was not an issue in 95. It became a big issue following 06, and the stocks behaved accordingly.
Steve?
So Gerard, when I look at, I call it Jamie Morgan, not J.P. Morgan anymore, because it's just such it follows one man at this point. I'm going to read you this one line. J.P. Morgan earned nearly 20% of all U.S. bank profits in the first 3 quarters of the year, taking in more than BAC Bank and Citi combined. Are we making this too complicated? Is just one bank to buy in the whole stratosphere of the financials?
Well, Steve, it's interesting because it was the stock to own this year, J.P. Morgan Chase. It was the classic risk-off name. As Tyler pointed out earlier, in the spring when we had those bank failures, money flocked to the risk-off trade, and J.P. Morgan was the direct beneficiary. If we are going to see a soft landing next year and the Fed, again, is at the terminal rate, I think investors are going to start moving to risk on. The likes of a Bank of America, Citigroup, Fifth Third, KeyCorp, all of these names would do better in a risk-on environment versus what we saw this year.
So let's talk a little bit about credit risks. If you see a soft landing or no recession, basically, there's not going to be much credit risk. They're not going to have to write off bad loans.
Tyler, you're absolutely right. And the interesting part is we have new accounting that came into effect in January of 2020 called CECL, Current Expected Credit Loss Accounting. And this accounting requires banks to look through their portfolio through a cycle and set aside reserves. Many banks are anticipating 5% unemployment over the next 12 months in setting up these reserves. Unemployment, as you well know, is closer to 3.7%. So if we don't see unemployment going much over 4.5% in 2024, the banks have already set aside a considerable amount of money to handle the expected losses in a 5% unemployment market, which possibly we won't see next year.